is $313,400, correct? It tells us that the book value of land was $65,000, but the fair value was $290,000. So what's the excess here? 225 is the excess of land. So the land here, 225. Let's look at the buildings and equipment. Look at this. The book value is 287, but the fair value is 263. So it's 24,000 less, correct? So we're going to take that, and that's going to be a minus 24,000. The copyright shows a book of 122, but a fair value of 216. So that's an extra 96,000? 94, gosh, sorry. 94,000. Then we've got a note payable. The book value is 176, but our fair value shows 157.6. So we were going to assume more debt than we really need to, right? So this is an increase for us, a benefit for us of 18,400. Thank you. 18,400. So we have a total here. I think I have to do equal sum. $313,400. Is there any excess to goodwill? None. Okay? Now we need to take these items and show the excess amortization we need to apply. So on the buildings and equipment, we have the buildings and equipment, because land we can't depreciate or have any excess, can we? You guys know that? Mm-hmm. You never can with land. So the building is a minus 24,000. What's the useful life? 10 years. So that gives us an excess of $2,400 a year. The copyright shows us 94,000, and I thought that was over 20 years. 20-year remaining useful life over 20 years. Who can help me with that one? 94,000 divided by 20 years? It's about 4,000? What? 4,700. 4,700. Then our notes payable is at 18,400.
8 years.
And that's for 8 years. 18,400 over 8 years is what? 2,300. So if we take these, $4,600 is our amortization. We don't take land into account because we cannot depreciate land. Okay? Now let's go back, and it tells us, for internal reporting purposes, Padre employs the equity method to account for this investment. The following account balances are for the year ending December 31st, 2015 for both companies. We bought this in January of 2015. I always check to see when we bought it. So it gives us our revenues, it gives us our cost of goods, our depreciation, our amortization, our interest, and we've got an equity income in Sierra, and then our various balance sheet. At year end, there are no intra-entity receivables or payables because we would have to get rid of that otherwise. Prepare a worksheet to consolidate the financial statements for these two companies. So let's go back here, and and let's look at what we'll need to focus on. The revenues. What are our revenues going to be for the combination of Padre and Sierra? So if we show here 1,394,980 plus 684,900, what does that come up with? 2,079,000 what? So it's 2,079,880. So this is book values combined. Okay? What about our cost of goods sold? It's going to be the same way. We just combine the book values. What is it? $774 plus 432 is 1 million. 1,206,000 book values combined. Depreciation's going to be a little different. What are we going to do? We're going to take the depreciation of Padre 274 and Sierra 11,600, and we've got some depreciation here of our building and equipment, a minus, don't we? That we need to take into account. So we've got depreciation expense is going to include the book values minus the negative depreciation. How much is that going to be, guys? Can anyone help? I'm going to start bringing the calculator. 283.2? Don't look. You're fine. Amortization expense. We're going to have to do something with this or not? What are our book values here? Amortization of 6,100, right?
Yeah.
And then do we have any that we've calculated here? Copyright 4,700. So we're going to add book value of 6,100 plus the 4,700, and that gives us what? 10,800. Interest expense. We show 52,100 and 9,200. What else do we have? Basically, in this scenario, we show our 52,100 plus our 9,200, and then we have to show our amortization here of the notes payable of this amount, because remember it was to our benefit here. So what are those two numbers I told you? 52, 100. I'm sorry, 9,200?
Yep.
Gives us what? 52, so that's 91 or 61.3.
Yep.
And then we need to add to that the 2,300 up here, the amortization from the notes payable. Gives us our 63.6, right?
Mm-hmm.
Good. Now, equity in Sierra. Ugh. What all do we need to do here? Equity in Sierra, 177, 120. What do we need to do with here, this equity in Sierra? Are we allowed to show equity on the combined financial statements? No. Remember, we have to eliminate that. So what would we show here? We would show 0. We need to eliminate. Okay? Does that make sense?
Mm-hmm.
What about consolidated net income? If we look at here, our consolidated net income is going to be what? 472 plus 226, 698. 472, 698. But we don't want this equity in Sierra anymore. So we need to get rid of this 177, 120, remember? So if we take the 472 and subtract from it 177, 120, what do we get? Add to that 226. 520, 880. 520, 880. And then our annual excess here is what? 4,600. So if you take the 520, 880 and you subtract this 4,600, what do we get?
516.
I'm sorry, what? 516. Perfect. So our 516, 280 is going to be net income less equity in subsidiary, because we're going to show them together, minus our allocation excess. Okay? Net income attributable to the non-controlling interest. So how are we going to determine the net income attributable to the non-controlling interest? Let's look at Sierra. Their net income shows how much? 226. Then what else do we need to do with that 226? Subtract our 4,600. 226 minus 4,600 is 221, 400. 221, 400 times 20% is what?
44,280.
Perfect. 44,280. So let me write this down. This is going to be the income from sub less allocation excess times 20%, I said? 44,280. What is going to be the net income to Padre Company? Couldn't we take the consolidated net income here of 516,280, subtract the 44,280? Get our difference? Make sense? So that is going to be 472. Retained earnings at the beginning of the period. Retained earnings here, Padre, Sierra, at the beginning of the period. Don't we want to wipe out Sierra's? Remember how the retained earnings, we always wipe out the subsidiaries' retained earnings? So it's just the parents, 1,275,000. I'll say just the parent. What were the dividends declared? Just the parent, 260, right? Anything intra-equity we get rid of. Just the parent. How about the retained earnings at the end of the period? Wouldn't it be just the parents there too?